Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon. My name is Michael Cerami, and I'm filling in as your host today for Eric Auskerson. I'd like to welcome all of you to this Thursday, November 4th edition of the AICPA Town Hall Series, where we will examine some of the most pressing issues from across the profession. The AICPA Town Hall is broadcast live every other Thursday at 3 p.m. Eastern Time, and our objective is simple. We want to bring you high-impact news with real-time insight and analysis. But these town halls also give us an opportunity to broaden the discussion with you, to talk about strategies, capabilities, emerging trends. The goal is to keep you informed and help drive your success. Last week's discussion on cybersecurity was a great example of this. So we have a beautiful, brisk November day here in New York City. I'm very excited to get started. I know many of you may be missing Eric, but he'll be back with us for our next broadcast. So let's go ahead and jump in and review our agenda. So our DC Update is back with us this week. Lauren Finstag, who many of you know, AICPA's Director of Congressional and Political Affairs, is with us today. The situation in Washington, as many of you know, remains extremely fluid, but Lauren will help us make sense of where things stand. Ed Carl, VP of Taxation, AICPA, will also join us today after Lauren. Ed has the latest on the tax front, talk about a moving target, and it would not be a town hall without Lisa Simpson. Lisa will join Ed to review some tips and insights as teams begin preparing for this upcoming tax season. Lisa also has a brief forgiveness update for all of you, and she will then join my discussion with Stan Sterna, VP Aon Insurance Services. We had an overwhelmingly positive response to last week's session on cybersecurity. There was lots of appetite expressed for continuing that discussion. So we invited Stan in today to speak with us, but more from the perspective of top mitigation strategies and important liability concerns, which were pretty widespread in the Q&A last week. So we wanted to bring in Stan as a subject matter expert to help speak to some of that. And then lastly, we'll wrap things up with an open forum and some closing comments. So without further ado, let's go ahead. There you see our familiar faces, but let's go ahead and bring in Lauren Finstag.
Hey, Michael, I'm so glad to be here to give you an update on what is happening with infrastructure and reconciliation, those bills in Congress right now. There have been some really significant events over the last week that tell me that we may actually be close to the finish line on both of these bills, which would be fantastic for everyone who is weary of kind of the ongoing drama and negotiations. So just as a reminder, House progressive members have been demanding for weeks that the votes on the traditional infrastructure package and the larger reconciliation bill, which is where all of the major tax changes will be housed, be held together. They have been worried that Senators Manchin and Sinema, whose votes are necessary for passage of the reconciliation bill, could completely abandon that bill if infrastructure advances on its own. Everyone, I think, is weary by the endless back and forth, the negotiations, the dramas. This has been going on for 8 months now, which is kind of hard to believe. And I think part of the weariness is that we all know how this play is going to end, right? Both bills will get passed. So there's a real feeling of are we there yet? And let's just get on with it. So late last week, Democratic leaders and the administration tried to take advantage of that weariness, and they made an urgent push for a House vote on the Senate-passed infrastructure bill. Democratic leaders really wanted to give President Biden a win before he left on his international trip to Glasgow. And they also hoped that passing the infrastructure bill would be something that would bolster the Democratic candidate in the Virginia governor's race. So the administration really quickly released a $1.75 trillion framework for that reconciliation bill. The House Rules Committee released 2,000 pages of legislative text based on that framework. And it was suggested that all Democrats could vote for this plan. And this was supposed to convince the progressive House Democrats who've been reluctant to release the hostage and vote on the infrastructure bill. It did not work. At least 30 House progressives were completely unmoved, and that planned vote on infrastructure was abandoned last week. And I know this sounds like the same drama, different day, but I am here to tell you today that these events should be seen as encouraging. We are almost at the end of this journey. The release of that 2,000-page bill actually represents a huge step forward in negotiations. It is not the final product. It's not what will be signed into law, but it does reflect about 75% of the tax and spending policy agreements between the House, the Senate, and the White House. And I think the House, despite the fact that nothing has really changed since last week, may actually pass both bills this week, perhaps even as early as tonight.
Lauren, that's a great update. It has been a pretty extraordinary week. Like you said, I think, before the president left for Rome, there was pressure applied. I know with Election Day on Tuesday, we thought that would serve as an impetus, but maybe even comment on that. I mean, has that really stirred things and put pressure to, even more so? I mean, as you just said, forgive me, I try to be the optimist, but I don't know what's changed. If nothing has really changed, you seem pretty optimistic that something might actually happen this week, but why is that?
Yeah, I think what you mentioned, Michael, about, events of the week, the Virginia governor's race, I think that was a real wake-up call, especially for House progressive Democrats who have been very willing to hold that infrastructure bill back because they want, a reconciliation bill to go. But, things didn't go as planned for Democrats in Virginia. And I think House progressives now are abandoning their strategy of holding the infrastructure bill hostage. And that strategy changed overnight. So they feel more confident this week that Senators Manchin and Sinema will vote for a reconciliation bill. And they know kind of what the bill is going to look like because we have those 2,000 pages of text. But really, it was, I think, the Virginia governor's race giving them a wake-up call. And I think they're hopeful that passage of both bills will improve Democratic and swing voters' perceptions of the ability of a Democratic-led Congress to govern and to get things done. But I'm also, weirdly optimistic about action this week because that 2,000-page bill has already been revised again, which tells me that outstanding issues are being resolved and text is being fine-tuned by experts. The second rewrite, which Ed is going to go over a little bit more in detail later on, added about 450 pages to the bill. A lot of it is under the jurisdiction of the House Ways and Means Committee. So we saw new language on SALT, revived language on mega IRA reforms, new language on paid family and medical leave. So all of the things that people have been really fighting over for the last month or so are actively getting resolved. And if the House does manage to pass both bills this week, the infrastructure bill, as a reminder, would go straight to the president's desk and be signed into law, while the Senate parliamentarian would probably take the next week to scrub the House-passed reconciliation bill for so-called Byrd Rule issues. And as a reminder, the Byrd Rule governs what can and cannot go into a reconciliation bill in the Senate. So we could get this all wrapped up, the week before Thanksgiving, the week of Thanksgiving, which would be really great.
So if they pass both bills this week, Lauren, what happens next?
If they pass both bills this week, like I said, the infrastructure bill goes to the president's desk for signature. And then the Senate's going to need a couple of weeks to scrub the text for, rule issues and make their changes and then pass it with 51 votes and it would get signed into law.
And then maybe even comment on what obstacles you see might be lurking out there that would prevent them from signing these bills.
Yeah, I'm trying to be so optimistic, but I'm always willing to talk about, the obstacles and how this could all go south because it so often does in Congress. The first immediate obstacle, Michael, is that there are at least 5 moderate House Democrats who really do not want to vote on this House reconciliation bill until they know the full cost and economic impact of it. And that assessment is done by the Congressional Budget Office, the CBO, which estimates the likely effects of proposed legislation on the federal budget, and also by the Joint Committee on Taxation, JCT, which does the revenue estimates for tax proposals. Now, around 11 o'clock this morning, JCT released its revenue estimate for the tax policy provisions, and it shows that the bill's tax offsets raise, I think it's $1.5 trillion over 10 years. And that doesn't even include another $500 to $600 billion in new proposals that we know are coming. So the JCT estimate covers the costs of the bill. But if members are insistent on waiting until that CBO score comes out, that's going to take at least 48 hours, which means the House may not be able to vote on the bill until the weekend. The other potential obstacle I'll note here is that the longer a bill sits, the more time members have to think about what they really don't like in that bill or what they really want in the bill. And Speaker Pelosi is operating with a 3-vote margin. So if 3 Democrats say that they suddenly really want something new in the bill, that's going to blow this whole thing wide open and action would be delayed even further.
Thanks, Lauren. So yeah, imperfect information, but I think that really gives us a good idea just where things sit right now. It is, I know it's an overused term, but it's clearly a fluid situation, and we'll do our best to just keep members updated as information breaks. So let's go ahead and bring in Ed, talk a little bit about the tax implications of what Lauren just discussed. Ed, welcome. Great to see you. I know everyone really appreciates having you on a town hall. Maybe before we talk about or dive a little bit more into the tax developments, you can talk a little bit about just some of the high-level advocacy efforts that we have out there as it relates to tax.
Yeah, thanks for having me again, Michael. I appreciate it. Yeah, our team in Washington has been quite busy. The first iteration of the Build Back Better Act came out at the end of September, and by October 1st, we had already submitted a letter with numerous issues in there. I think we spoke about 15 or 16 different issues in that first letter, and then submitted several other letters over the next couple of weeks about specific issues alone. So we've been quite busy advocating on behalf of the profession regarding the reconciliation bill. Why don't we move on and get into some of the changes and a little bit of sort of summarizing some of the things that Lauren mentioned. So I mentioned the Build Back Better Act. HR 5376, that was moved out of the Ways and Means Committee on September 27th. Then about a month later, the end of October, the Rules Committee issued amendments to the HR 5376. And we were about to talk about what changed in that bill today. And then yesterday, the manager's amendment came out to that first amendment. And so we have 3 iterations. What I'm talking about today is what is in the House bill. And these are some of the things that dropped out through the manager's amendment. So we spoke about a corporate income tax rate increase. That's been part of the conversation for quite a while. That drops out. Surprisingly, carried interest rules, which have been discussed in Washington for 14 or 15 years of trying to make some changes to the way carried interest rules are applied and make them treated more as ordinary income. Those dropped out. The individual ordinary income tax rate increase. So bringing back the highest marginal tax rate that was changed with tax reform several years ago. That's dropped. If some of you might remember, because it wasn't around very long, the short-lived billionaires tax, which was somewhat of a mark-to-market for billionaires, it really only impacted maybe about 600 or 700 taxpayers. That was discussed for a while. That drops out of this latest version. Capital gains and dividend rate increases gone. QBI changes, those are gone as well. Changes to the rules to grantor trusts, which a lot of people did not like. Some of the valuation limitations on transfers of non-business assets, those are gone. Now, the estate tax valuation rules, same thing. And then I'll talk about the early sunset of the unified credit. Remember that in TCJA, they basically doubled the unified credit, but as applied to many of the individual provisions, that unified credit doubling was set to sunset 12/31/2025. So one of the pay-fors of the act, HR 5376, was to have an earlier sunset. So for estates created starting 1/1/2022, that's been dropped as well. So there were quite a few changes. Now, I mentioned the three iterations, and Lauren talked about some of the pages, but since we're all CPAs here, let's talk about the numbers a little bit. The first version, HR 5376, had 2,466 pages. There were a lot of changes coming out of the Rules Committee a week or so ago. They dropped it to about 1,680 pages. And now with the manager's amendment and some of the pressure put on the members of Congress because of the disappointing showing in the elections on Tuesday, a lot of the environmental and social safety net rules were changed yet again. A lot of items that members had seen drop out in that middle version, those came back again this week, as well as a shuffling of some of the pay-fors. So, Michael, let's look and see what came in with this new version. So I mentioned that the corporate rate goes away. There was quite a lot of revenue associated with the increase in the corporate tax rate, about $740 billion. They replaced some of that revenue, maybe about 40% of it is replaced with two items: a 15% corporate AMT based on book income. That's actually something that we do not like. I mean, AMTs are something that we have never really been in favor of because of the complexity. It's an alternative system. If taxpayers are taking advantage of the rules, as they should be taking advantage of the rules, then shift the actual rules rather than having sort of an alternative side system in place. We're also not thrilled with the idea that it's based on book income and it creates a whole set of challenges. That slide that Michael showed when I first came on with some of the advocacy work, we have a specific letter dealing with that issue. Also, changes to the R&D that would allow them to be fully expensed, a 1% excise tax on the repurchase of corporate stock. That 1% excise tax and the corporate AMT are the two that raise about $400 billion to replace the loss of the revenue from the increase in the corporate income tax rate. Revised SALT cap. Surprisingly, that's been discussed for months, and we hadn't seen anything. And finally, in this third version, something surfaces. Significant increase from $10,000 to $72,500, $72,500. And it's applicable for tax years that begin after 12/31/20. So we talk about retroactivity, and a lot of our members complain about or raise concerns about retroactivity. This one, I don't know if people will complain about it, but it applies for the 2021 tax year. But interestingly, I mentioned the sunset of most of the TCJA individual provisions. This one was scheduled to sunset at 12/31/25. With these changes, they increase the years of sunset. So in other words, instead of sunsetting 12/31/25, it won't sunset until 12/31/31. So that's quite a significant change. Net investment income tax has been expanded, and then in replacing the highest marginal tax rate for individuals is a surcharge on high net worth individuals, also estates and trusts. For the individuals, it kicks in at a modified AGI of $10 million and then at $25 million. But please note that for estates and trusts, it kicks in at 200 and 500,000. So let's go on to the next slide, Michael, and talk about some of the surprises. And I'd like to talk to Lauren a little bit about what we see. So Lauren, interestingly, I mentioned the SALT cap, and that's been on everyone's radar for months, and it finally makes it in. But the question is are we seeing the last changes to the SALT cap or not? Will it stick?
And the quick answer is no, this is not the last change. I think House Democrats thought that they could pull off a budget gimmick and create a self-financing, SALT cap fix, but it's just not going to fly in the Senate. We already saw Senator Sanders and Menendez come out and say they would not vote for this increase in the cap. What they would vote for is something that would allow, that would eliminate the cap for everyone making up to a certain amount of money. I think it's around $400,000 annually, maybe as high as $550,000. So, this is an interesting SALT fix, but it's not the one that's going to be voted, passed into law.
Yeah.
So Lauren, just on that though, so again, Dems are saying it's self-financing. How what's your observation on that?
Yeah, it's funny. It's a budget gimmick. You front load the cost of the proposal. In this case, raising the cap from $10,000 to $72,500 for about 5 years. And then you backload the savings by pretending like you're going to reinstitute a cap, even at a higher level, for 2025 through 2031. So it nets out to about $2 billion over 10 years in terms of cost. I think that's what JCT scored it at. But everyone knows this is a paper trick, and that's why Senator Sanders and Menendez, and I think others, are not going to let this one pass.
Got it. Back to you, Ed.
Yeah. So if we have all these changes looming in the Senate, Lauren, and some of them will have to be paid for, the corporate rate increase, which was dropped out of the last two versions of the bill, which have been discussed for quite a while. I think the Biden campaign had raised the idea of increasing the corporate rate in the campaign, and then with the Treasury Green Book earlier this year coming out of Treasury as part of the budget proposals, raising the corporate rate, and now it's gone. Have we seen the last of a corporate rate increase? Might we see something come back?
I think that's a great question, Ed. I think we may have to see an increase in the corporate tax rate. Every percentage increase represents something like $100 billion in new revenue over 10 years. So the thing to look for is the CBO score. If the CBO score comes out in the next 72 hours and it estimates that the cost of the House's Build Back Better Act is significantly over $2 trillion, which very well might happen, then the Democrats are going to be on a hunt for revenue because they can't really eliminate items at this point. Everything has been so finely negotiated. So raising the corporate tax rate from, to 22 or 23% seems like a pretty easy thing to do.
Yeah. How about another one? I know members have been asking about the ERC, Employee Retention Credit, and the infrastructure bill contained an acceleration of the sunset. So it's originally scheduled to sunset 12/31 of this year. and they moved it to September 30th. Well, we're now into November, and we're seeing a lot of confusion. And in fact, this was one of the items in our advocacy letters that we raised a lot. But does that look like there will be a retroactive sunset of the ERC?
I think there will be. There have been several key members in the House who've written to Speaker Pelosi saying that they think the early sunset of the ERC is a bad idea, that it's confusing, that it was the wrong pay for to include in the infrastructure bill. But the infrastructure bill is untouchable at this point. It passes as is. So if there were to be any changes to that early sunset of the ERC, it would have to happen in reconciliation. And so far, you don't have 3 Democratic House members or 1 Democratic senator making this their red line in the sand and saying that you have to fix the ERC issue to gain their vote on the reconciliation bill. So I think the early sunset is going to happen, unfortunately.
Yeah, we've been concerned about that. There's concern about potential penalties for taxpayers who have legally taken advantage of the ERC because it's still currently part of the law. So if it's retroactively repealed from a taxpayer who's taken advantage of it, applying penalties would be egregious from our perspective. And also taxpayers may need to have provision of how to pay it back. So I appreciate your thoughts on these. Michael, why don't we move on?
Yeah, Ed, I was just going to say, one final question before we bring in Lisa and talk a little bit about tax season preparation, but anything not on this list that members need to be thinking about or concerned about?
Yeah, I'm going to emphasize this one. Paid family and medical leave. That benefit was not in the framework that the Biden administration released. It is a 4-week benefit, is in the newest bill from the House. It would cost, I think, about $200 billion over 10 years. Senator Manchin does not want to vote on this as part of a reconciliation package. I think he'd like to do, he's been opposed to this benefit in the package. Speaker Pelosi is putting it in the bill and essentially daring Senator Manchin to vote against 4 weeks of paid family and medical leave because she thinks she has a winning issue and she wants to put him in a tight spot. But I think for our awareness, why it's important to the profession is if it adds $200 billion to the cost of the bill, Democrats have to go on the hunt for revenue again. And so you have to look at some of the things that have been proposed that didn't make it into the House bill, maybe bank reporting, maybe pay prepare regulation, like Ed said, a corporate tax rate increase to offset this new benefit if it makes it through.
Great. Thanks, Lauren. Yeah, it all has to balance out in the end. So Lauren, this was great. Thank you. We'll bring you back in an open forum, and let's go ahead and bring Lisa in to join us. And Ed and Lisa, I know it's early, but we're starting to think about next tax season. So maybe you can provide some insight and input to folks about preparing for
that. It seems like, from what we hear from our members that the 2020 tax season is just we got past that one. We're already heading into 2022. It's like one elongated tax season, but we had 2020 with the start of the pandemic, which was pretty challenging for people. And then 2021, we never thought this would be the case, but it got worse. We know that from speaking with our members every day. We also know it from an annual survey that we do and asking about and the challenges that our members have with IRS services. But now, Lisa, we're headed into a 2022 tax season on the heels of what likely will be the passage of a very large tax act. And so our members really need to be particularly focused and smart and maybe pick up some additional ideas to help them get a good start to the next year.
Absolutely. It's what we keep calling Marchternity. It's just never ended for so many of you. So what we wanted to talk a little bit about today, and we're going to keep talking about getting ready for busy season throughout the course of the rest of the year. But right now, we thought Ed and I could just talk about some of the risk mitigation steps that you might want to start thinking about We've got Aon a little bit later on our broadcast today, and Aon is our professional liability insurance broker. So they've provided a great resource for AICPA members that you'll find in that link that's on the slide. So as a reminder, download the resource slides. You'll get them in the resource section of the materials, and you'll find live links, because I know some people were looking for links to the advocacy letters. You're going to want this link because it's going to give you some great tips on, again, some risk mitigation, risk control steps that you can go ahead and start taking. We know that a lot of you are really interested in the tax section annual compliance kit. That's going to be coming out in November and December. So we'll make sure you know as those resources are released as well. Ed, is there anything in particular on this slide that jumps out at you as a key first step?
Well, I would say, yeah, number one, I teach tax ethics, quality control, those types of courses over the last numbers of years. And when I ask members, a lot of members don't have insurance. They don't have liability insurance. And I think having liability insurance has always been important, but in the craziness of the last several years, I think it's particularly important, not just from the protection, but from the assistance that the liability carriers provide to their customers, and the materials that they give them, the questions that they can answer. And similarly, I'm a big fan of AICPA's tax section, which has quite a bit of material for our members who are focused on tax. And tax season is challenging, and our tax section has quite a few resources to help out. So I'm a big fan of those two ideas, of the tax section and insurance.
I'm going to call out the one about getting your plan together for those procrastinators. You know who they are. Every year on April 15, I knew who was going to be rushing in trying to get their extension done. Go ahead and get your plans ready, get your resolve built up, and start communicating to your clients what your cutoff dates are. Communication is going to be so important in this upcoming tax season, and you're going to have to be realistic about what work you can get done, maintaining that commitment to quality, given all of the challenges that tax seasons are throwing at us these days. So start thinking about what your plan is there and get those communications ready. That's going to be my shout out.
Great.
So we're going to come back in open forum, and I'm going to ask Ed some of the tax questions you guys have been throwing into the chat. So we're going to revisit that ERC topic that y'all were concerned about, and we're going to hit. I've just given Ed and Lauren a heads up that I'm going to ask you about ERC again, and I'm going to ask you about mega IRAs. So we'll get to that in the open forum. Really quickly, let's talk about PPP forgiveness. I am seeing some questions come in about what to do if you've gotten a notice from the SBA that your loan forgiveness application is under review. I'm going to ask that you be patient. That word that I've been throwing around for the past 18, 19, 250 months. The SBA is using data analytics to speed up the forgiveness process. By all measures, it seems to be going really well, and you'll see that we are making a lot of progress on here. So we're making good strides, but the SBA will review some loan forgiveness applications. So hold tight. If you get a letter that your forgiveness is denied by the SBA, there is an appeal process if that forgiveness decision differs from what the lender has suggested as well. So we'll dig into that on another town hall. But let's quickly look at how we're doing on forgiveness. If you look at the overall statistics by loan size, it's looking really good, getting lots of movement and positive forgiveness rates at over 99%. So getting good results there.
Great. Thank you, Lisa. Let's go ahead and bring in, and Lisa's going to stay on with us. Let's bring in Stan Sterna. Hey, Stan, welcome.
Hey, Michael. Thank you for having me.
So, Stan, we had probably one of our most popular sessions last week. It was an extremely sobering session from the standpoint of just seeing how much threat persists out there in the cyber world, and really the implications for financial services in particular. But again, like I said, people really appreciated the information, the education, but naturally it moves people to think, okay, I understand the threat, and now I want to be able to mitigate risk and manage the threat. And so we thought it'd be great to have you kind of come in, maybe do a quick recap on what the team or what attendees heard last week, but then also attack this a little bit from the client data side and some of the liability considerations that practitioners in particular need to keep in mind.
Yeah, sure, Michael. I mean, everyone knows that ransomware, it's basically malware designed to encrypt the file, obviously. And so you're basically your systems are locked until you get an encryption key. And malware can infiltrate a network on through various means, but I guess the more prevalent way they do it is through social engineering, and usually through email business compromise, where they imitate or impersonate somebody, maybe a client, maybe an executive at the firm, asking for them to either release data or transfer money or funds. Or they do it by serving as a kind of a trusted institution, and basically kind of enticing the recipient to click on a link or click on a download, and then that link or download will basically infiltrate the system with the malware to lock the computer, and then they demand the ransoms. And social engineering is one of the primary, if not the primary method of doing this. 91% of cyber attacks, as this slide indicates, came from email. Some sort of email compromise or suspicious email. And, one thing I think it's important to note is that 43% of cyber attacks occur in organizations with less than 100 people. And I know we're going to talk a little bit later about, is it the size of the firm? Does it matter in terms of whether or not you can be a victim? And I think that statistic is important, amongst other things that we'll discuss. But just from the perspective of what's going on with ransomware, from my standpoint, I am seeing a significant increase in both the frequency and severity of these type of incidents. Last year, within the AICPA insurance program, ransomware consisted of 12% of all cyber claims. Doesn't sound like a lot, but I can tell you that in previous years, that was a single-digit number, and not that long ago. I have seen over the last 5 years a significant proliferation in these type of schemes, whether it's ransomware or more sophisticated cyber schemes. When we first were dealing with these issues, a lot of it was a lost laptop or a stolen flash drive, and they were more interested in getting the hardware than actually the data. That's not true anymore. The frequency and the severity of the ransom demands have increased significantly. Last year, the average was $170,000. With a total cost per incident. Now, that's just not maybe ransom, but also legal expenses and payment for recovery, forensic assistance, and business interruption, $761,000 on an average. So that just goes to show you the significance of these type of incidents. And why is that happening? They're getting bolder. And I think one of the main reasons that we see is, taking advantage of people's trust, people's fear, and people's sense of urgency. And over the last year with the pandemic, people are trusting fake emails that come from the CDC or from their employer saying, we're changing travel profiles. So click on this link and change your travel profile. So we know, if you're traveling overseas. And these links are a lot of times, just basically an invitation to allow a malicious malware to enter into the system.
So Stan, let's move in, again, this area of client data and really what our responsibility is as a practitioner, protect it. And then again, some guidance for firms as it relates to it.
Yeah, I mean, there's obviously different laws and regulations that pertain that we have to follow. CPAs have to follow. Obviously there's the code of professional conduct and the duty of confidentiality. If you're doing tax work, there's Circular 2230 and returning of documentation. There's Section 7216, where if you're knowingly or recklessly allowing the use of tax return information, you could be subject to not only fines but imprisonment. And then there's the IRS publication 4557, which provides a pretty good basis or at least framework for one to understand how to report, how to see red flags in terms of a malware, any sort of systems situation or infiltration in the system. So we all know that there's responsibilities and there's laws, and we'll talk a little bit later about the patchwork of, as we noted here, about states imposing their own requirements. There are no national or federal data security breach notification statutes. They've tried to do that in Congress. It hasn't worked. There's, I guess, bigger fish to fry, or it just has not been much traction on that. But in the last, I would say, 5 years, all 50 states have enacted some sort of breach statute, breach notification statute, and some are more onerous than others with regard to reporting times and what you need to do. And then there's 3 states, I believe it's California, Virginia, and Colorado, that have more comprehensive consumer privacy laws that have to be kind of state, kind of a state version of GDPR in specific states. So that's another legal and regulatory, implication for, making sure that, you don't want to be in the crosshairs of any of that in terms of maintaining client data.
And Lisa, maybe come in here too. I mean, again, I think we always fear as people listening say, hey, big fish, those are the targets, but we have a lot of small firms, and I don't know that that's the case. So maybe you and Stan can talk a little bit about that.
Yeah, thanks, Michael. And I've talked with some small and medium-sized firms who have been subject to some breaches, and they may not have been having all of their maintenance patches up to date, or someone got caught with in one of these phishing expeditions and it worked. So, Stan, do you feel like small firms are facing the same types of risks that large firms are? Or do small firms feel any comfort that they don't have as much data?
Yeah, I honestly, Lisa, I don't think it matters anymore, the size. CPAs, in essence, by what they do, they're aggregators of data. They have data that is personal identifiable information. They have information that is obviously financial information. They have access to client funds. So they're an attractive target. And I will say that there's statistical evidence since the Colonial Pipeline hack went down in May that a lot of the ransom attackers are concentrating rather than on large game, such as Colonial Pipeline or a large company. They're hunting mid to small game, so to speak. And, what that means is they're going to go after firms or companies that are much smaller. Why? Because the perception is that those firms just don't have either the financial nor the inclination or financial wherewithal nor the inclination to want to set up any kind of data security framework. So they're preying off that belief that I'm too small to be attacked, because the general MO of the ransom attackers, we only hear about the big attacks, in the news media, but the general MO is not to target a specific company. They might, if they're some sort of nationalistic, state-sponsored group. But if you're one of these individuals who is buying a ransomware package off the dark web, which is sold, ransomware as a service on the dark web, you're looking for a company that is an easy target, something that some company that lacks preparedness, so that you could get in and it could be a quick and easy return on your investment, meaning you get a ransom paid. And accounting firms are a prime target, not only for the reasons that I stated, but they're looking at it as they're not in a situation, or they're just beginning to get into the stages of security preparedness. And so they're all main targets, along with law firms, financial service firms, because they all maintain the same type of information, valuable information to the ransomware attackers.
So Stan, a couple of...
Go
ahead,
do you want
Lisa,
to
I'm
talk
sorry.
about some ways to mitigate some of the risks?
Yes, and if you can, Michael, maybe we could switch to the next slide. So, and I know a lot of these were discussed in one shape or the other at the town hall on October 21st, but they really do bear repeating. And there's a lot of things that you can do, but I tried to crystallize them into kind of the more doable and types of things that you can do. One is just practice self-awareness. And I mean that, what I mean by that is slowing down when you're answering an email. I got an example here on the first bullet. Check to see if the email is legitimate. The first email address and the second email address I have on here are not the same. But if you take a quick glance, they look the same. The first one is to torn@acme.com. The second one is to tom@acme.com. Sometimes it's going to be very clever, the little nuanced, issues that you see with an email address. And if you're everybody's busy, everybody's working hard, everybody wants to get the information out to their client, but just pause and reflect. Pretty simple tip. Next is employ multi-factor authentication. That requires more than just a password to access the network, remote or otherwise. It could be a hardware security key, that could be a fingerprint, can be many different things. Use a VPN.
Hey, Stan, because
Yes.
we hit some of this last week, I think folks are eager to maybe jump in, because we are managing time here, just to jump into some of the liability concerns and insurance considerations. So maybe we can hit this slide.
Sure, Michael. Insurance considerations, you always want to consult with your with your insurance agent and broker, and you want to determine if you're adequately covered for, first of all, third-party claims. Third-party claims by your client, by a vendor, by any third party, saying the breach that was caused, or the breach that happened in your system caused me some sort of damages. You want to make sure that you have reasonable and necessary expenses are going to be covered to respond to any kind of threat to launch an attack or disrupt your network. You want to have coverage for lost income from any kind of business interruption and data restoration as a result of a ransom attack if you're offline for a while. Very important, you want to have legal expenses and legal assistance and forensic assistance for somebody to come in and assist you with all the legal obligations for breach notification. And also providing forensic assistance to determine, what was stolen, if anything was stolen, what systems were hacked, what systems have been infiltrated. You want to have coverage for regulatory proceedings and fines. You're going to have to, you have the possibility that you're going to have to defend regulatory proceedings, which is going to cost money. And there's also the possibility of fines. You want coverage that will adequately provide a transfer of liability for those. And these next three are kind of sometimes separate from cyber policies, and they exist more of in a crime policy. Computer fraud, which is essentially use of a computer by an outside party to fraudulently transfer covered property, important covered property, through an unauthorized and intentional use of corrupt code. Funds transfer fraud, where there's a fraudulent instruction that someone follows, then you direct a financial institution that may have access to your client funds in order maybe to transfer, to pay, or deliver money or securities to an account that's run by the criminal. And then social engineering fraud, basically what we're talking about. Intentionally misleading a firm employee through some sort of communication method by a party who is not who they purport to be. You want to have specific coverage for that. So it's careful when you're talking to your agent or broker to make sure you're being adequately covered to transfer these risks.
Stan, go ahead, Lisa.
I'm sorry. So really quickly, I've gotten questions from some firms who are interested in getting cyber security insurance coverage, and they're not quite sure where to start in terms of documenting what their current plan is. So around cybersecurity. So we've given the cybersecurity checklist in materials the last week and this week, but underwriters might be different, states and localities might be different. What do you think is a good place to start if an entity has never had coverage before, but they need to be documenting what their processes and procedures are to get that coverage?
Yeah, I mean, I think the cybersecurity framework that you guys provided and we looked at, that I analyzed or looked at it before the actual session today, provides a lot of the things that you want to have in place. So it's a very good framework to start with. The Department of Commerce, the NIST, so that's the National Institute of Standards and Technology, provides a very, very good framework to follow as to, what are some specific, cyber data security protocols that you can put in place. A lot of the things that we mentioned are important. Underwriters are taking a much more vigorous approach towards cyber now. And because, obviously, for the reasons we mentioned, for the significant increase in frequency and severity. And they're looking at the types of things that we mentioned. Are you putting those in place? It's important to have business response plans. It's business continuity response plans and disaster recovery plans in place, as well as backing up the data, installing patches, all the things that we've talked about, either in the previous slide or at the last town hall. So those are two very, very good sources. So I'd also, to the extent you can, take a look at your state's breach notification and data security protocol statutes, if any, if they have protocol statutes. There is, I would suggest maybe going to the ncsl.org. The the NCSL is the National Conference of State Legislature, a not-for-profit, nonpartisan group who provides updated information on state information, state legislative initiatives, bills, and it includes, and it updates it regularly, information on your specific state's laws and regulations. So I would also encourage folks to go there as well.
Michael, I think that's a great lead into the next slide, which is where we list out some of the resources that either Aon has provided, and that's the surviving tax season checklist to manage your risk that Ed and I talked about earlier. But we also have some resources from AICPA and from the tax section that actually give you some templates on what the IRS required. But you've got some really good intel from Aon and some of our Journal of Accountancy articles as well.
Yeah, and the one thing I'd mention, Lisa, is the eRisk Hub, which is for our program members who have the CNA cyber endorsement. A lot of great resources on there, whether it's expert blog information, whether it's frameworks for business continuity plan or disaster recovery, vendors. So that's a great resource as well.
Stan, thank you for being with us here today. It's a hot topic. As with most things, we can continue this discussion. We'll have to have you back because I think there's a lot more that we can do. So we're going to go ahead and move to open forum, and let's go ahead and bring Ed and Lauren back in. We have a few minutes left, guys, and I do think we maybe want to come back to the ERC topic. Lisa, I'm going to throw it to you. Maybe you have a question for Ed or Lauren specifically on that.
I do. So after we talked about ERC possibly sunsetting based on what's in the bipartisan infrastructure bill, we got lots of questions about, okay, are we saying that it would sunset September 30, even though it's November 4th? That's the way it's written currently, right?
That is. And I think you have to remember that infrastructure bill was being negotiated in May and June of this year, when everyone thought that COVID was behind us and we were all preparing for our hot vax summer. So I think lawmakers didn't really think about the fact that there would be another variant of concern, that the ERC would become important again, and that more small and medium-sized businesses would probably want to take it up. So I know lawmakers are questioning that decision now, but the infrastructure bill is sacrosanct. It cannot be open. The only way to reverse the planned early sunset is through the reconciliation bill.
Okay, thank you. Ed, we got some questions about what's going on in the draft legislation that came out around mega IRAs. So those have been in the news a lot lately. Any insights on where that would stand? as
Well,
currently written?
it's in right now, right? So it was in the original version, marked up by the Ways and Means Committee. Then the Rules Committee dropped it, and now it's back. So the manager's amendments add back those mega IRA changes. It applies to IRAs that are at about $10 million. So it would prohibit contributions to that size, and it would mandate mandatory distributions from IRAs and Roth accounts at the $10 million level. I think it also required annual reporting to IRS at a lower level. I think it was $2.5 million would IRAs and Roth accounts would have mandatory annual reporting to IRS. So those are in right now. But as Lauren and I have both said, we don't know what the final version will hold. This has to go, even if it's approved, passed by the House, it's still subject to a version by the Senate, and there's a lot that the Senate will not agree to. So
And
we'll have to see.
I'd add to that, Lisa and Ed, even if the mega IRA and the retirement proposals drop out of the Senate version, the final version, I think they could come back to life by the end of the year. The Senate still wants to do a big retirement package, Secure 2.0. They could do that by the end of the year or early next year. And I suspect that those retirement provisions, if they are not included in reconciliation, could be slipped into one of those packages.
Yeah. The other thing to keep in mind about that is these provisions are favored by Chairman Neal of the Ways and Means Committee. So when the chairman of the Ways and Means Committee likes it, it has a leg up on moving.
All right. So to quote Mark Peterson, it's not final till it's final.
Exactly.
All right.
Well, so guys, I really just want to say thank you to all of you. As usual, we went right up until the end of our time. Lauren, Ed, Lisa, Stan, great content, great coverage. Really appreciate your participation. Let's go ahead and just remind all of you again that if you missed a town hall, they're all available on AICPA TV, so you can find all the replays there. We encourage you to go back. Again, there's a lot covered, so going back and rewatching some of this stuff, folks have told us is very useful and very helpful. Want to remind everybody that .cpa launched this week in Canada. Again, have really good adoption happening here in the U.S. and it was exciting to be able to take this top-level domain global into the Canadian market this week. Lastly, today was a great discussion. Really appreciate all the engagement from the audience. I think if there's three things we wanted to leave you with here today is, again, the situation in DC continues to be fluid. You probably all are tired of hearing that, but just stay tuned for rapid developments on BBB and the infrastructure bill and for the corresponding tax implications. The team here is covering it very closely and will be available as soon as there's more information to share. Again, tax season preparedness can start now. I know there's beyond fatigue in the system, but to start thinking about next season is a good next step. And then there's many layers to this whole cybersecurity planning. I think what we kind of have tried to cover for you is clearly there's a risk mitigation strategy. There's a breach response protocol, and then there's thinking about your liability considerations. Again, to quote one of the former directors of the FBI, not too long ago, it's not if you're going to be breached, but most likely you will be breached, and just to make sure that you have the right response in place so you know what to do when and if that happens. Lastly, I want to remind you that our next town hall will be November 18th, Thursday at 3 p.m. Eastern time. Eric Askerson will be back in his seat at Command and Control. I'm sure it's beyond upsetting to him that he can't be with us here today, but business took him elsewhere. He'll also have with him Barry Melanson and Bill Paroli as guests, CEO of the AICPA and former chairman of the AICPA. They'll both be back with Eric on November 18th, along with other guests. And then our December 7th town hall will be on a Tuesday at 1:30 p.m. Eastern Time. It will be live from Digital CPA, which will be in Nashville this year. So as you know, on occasion, we go off of the regular calendar for some of these special edition broadcasts. The last one we did like that was at Engage over the summer. So we're excited to be live at Digital CPA for our December 7th broadcast. So thank you to all of you. Hope you all have a great rest of the day, and thanks for being with us today.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.